this is Brian Resney, president of Resney Wealth Management and host of the Resney Wealth Report. We have an excellent show for you today, and as always, send your questions to Brian Resney at ResneyWealth.com. And make sure you visit ResneyWealth.com. Download any of our groundbreaking reports. They're free and instant download, and a great education around your retirement and your investment portfolio. You know, I get a lot of questions all the time, not only about the economy, but we're going to talk about changing dynamics for 2025 and areas that you should ultimately be invested. We're going to talk about asset allocation and why set it and forget it isn't effective. Unfortunately, the vast majority of investors, and this would be the majority of probably you watching today, are probably working with a fee-based or commission-based advisor. Unfortunately, most of you don't realize they're all pushing what's called asset allocation, set it and forget it portfolios. And that means you're pretty much invested all the time in the same asset categories, and it really is ineffective not only to the risk management of your money, but in our opinion, it's ineffective to really grow your portfolio, in a pro-growth policy. Remember this, if you're setting and forgetting your portfolio and asset allocation, which again is pushed by, in our estimation, 90% of firms, it ignores changing market dynamics. So as things are changing, your portfolio is not changing. You're not aligned, you're misaligned with your overall retirement needs. So think about this. If there's a new administration coming and your portfolio is in the same asset allocation, it's misaligned for growth opportunities. Lack of risk management is another big one. There are times you may want to raise some cash. There's times you want to have different kind of bonds or no bonds in your portfolio, or there's times you may want to have more technology, more value, more growth, different asset categories at different times. Those missed opportunities, by the way, in our opinion, could account for 2 to 4% annualized loss in return. That's pretty large. Think about $1 million portfolio over the next decade that basically is missing an extra 4% return. If you do the math, you could be talking 60 to 75% larger income stream and or larger portfolio by making appropriate changes. Failure to adjust for lifetime changes. As you age, as you retire, as your portfolio changes, as the economy changes, there's going to be different life changes in your situation. Does asset allocation really reflect that? What I often hear from investors that hire Resney Wealth Management is, boy, I've talked to my advisor a lot. Why are we always in the same asset categories? Why don't we look at things like information technology or AI? Isn't that a better opportunity for growth in my portfolio? And usually the comment that they usually get back is the same old, same old. Well, this is how we asset allocate, and we basically rebalance your portfolio quarterly. Again, ineffective, loss of opportunity, loss of risk management, and ultimately loss for extra financial security and lifestyle for you and your loved ones. Zachary from Sarasota, Florida. I just inherited $800K from a family death. I have $30K in student loans and $100,000 left on my mortgage. How can I turn the rest into a solid nest egg? Number one, Zachary, make sure you find yourself a firm that can actually manage your money. Look for a fee-only fiduciary money management firm. Go to ResneyWealth.com, click on our special reports tab, real advisor, fake advisor, so you can interview somebody properly. The first thing I would say is don't necessarily pay off the mortgage because your mortgage may be at a low rate. If the money is invested at a higher rate after tax than what you're paying on the mortgage, keep the mortgage. As for the student loan, same scenario. If the student loan is at a cheaper rate, interest rate, than you're going to make on the portfolio, then obviously keep the student loan. But if you're ultimately going to invest the money and the rate of return is less, then you want to look at paying off those. Look at pro-growth in your portfolio. Depending on age, which of course I don't know at this point, and depending on how the longevity of your goals are, you probably want to be more growth-oriented, especially if you're younger, in order to grow that portfolio for retirement. And if you are retired, that doesn't mean that you should not be growth also. Just because you retire doesn't mean you need to get more conservative. You can still stay growth as long as your goals and objectives and your risk profile aligns. Luke from Bonita, Florida. I've heard you mention before that America's debt will eventually catch up. Wouldn't that make the economy collapse? And also, should I invest in gold? Luke, Generally speaking, there will be a point in time if we continue this reckless path of spending and the debt gets too large. We are probably a couple decades away from that, to be brutally honest. So I'm not concerned today or tomorrow or next year. I'm more concerned that we've got to get our fiscal house in order, certainly in the next 3 to 5 years, so it doesn't keep ballooning up. But with that said, your question on gold investments. We currently do not own gold. I would not buy silver. I think there's better places to invest than gold right now for growth opportunities. Gold is more of, and I'm going to call it a speculation, emotional, warm and fuzzy feeling investment. Gold has underperformed a lot of assets within the equity-based market. Again, where's the best place for the money today? If gold was one of the better places, we would have a position. It isn't, so we don't. Bill from Fort Myers, Florida. I'm 50 and I'm self-employed. Should software stocks do better this year or next? Great question. Generally speaking, Bill, this is how we look at software stocks. It depends on what sectors they're actually benefiting. So if you're looking at, as an example, AI, artificial intelligence, if you're looking at areas for basically protecting data, those would be areas in the software side that we would think would have a good opportunity for future growth. And why is that? Because artificial intelligence right now is growing at 2 times faster adoption than the PC revolution, personal computers, or the internet. AI is going to exponentially grow faster and faster as years go on. It's going to be in every part of your life. So I believe investments within technology that contribute to AI are going to be hugely beneficial for a portfolio. On the software side, when it comes to protecting your data, as we all know, we're being inundated with hackers and everything else, not only on corporations, but also on the personal side. So software companies that cater to protection of your data, I think, are going to be big beneficiaries of growing earnings and sales and revenue. These are going to be areas, again, not only in the AI technology, but data security. These are areas information technology is going to be vitally important going forward. And it's areas, if you believe in a pro-growth policy, which we do and we're positioned for, you should also. Unfortunately, what I'm finding with people that hire our firm or that are coming from other firms are really in this malaise of no growth, more value dividend-paying stocks that are not growing earnings and probably don't benefit a portfolio. We're going to take a quick break. As always, send your questions to Brian Resney at ResneyWealth.com, and make sure you visit our website, ResneyWealth.com, for all kinds of great information. If you're unhappy with the way your money is being currently managed, or maybe you're starting to realize you've got a set it and forget it advisor, set it and forget it portfolio that's not dynamic, that's not changing to current situations, and giving you the true opportunity, it's probably time you called Resney Wealth Management. We do manage larger portfolios. Go to ResneyWealth.com. I'll be right back. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ResneyWealth.com and download your free copy. I hope you're enjoying today's program, and as always, make sure you do send those questions to Brian Resney at ResneyWealth.com. Let's talk a little bit more about asset allocation and the set it and forget it mentality that is really pushed by Wall Street style firms, banks, and insurance companies. So the question I often get is, well, if really asset allocation is really ineffective or not as beneficial for your money, why do these firms push it? It's pretty simple. Higher fees or higher money for the actual Wall Street style firm. By encouraging hands-off approach with asset allocation, again, set it and forget it, these institutions, these firms, basically can continue charging you high fees and really not actively manage your money and actively press for higher performance. So what happens when you have asset allocation? It's almost generated from a computer. You put in a pie chart. It's kind of like going to the buffet and basically picking everything off the buffet, even though some of those items on the buffet do not make sense for your plate. Asset allocation is simply ineffective. It's a simplified sales process for the advisor to basically sell the investor, which basically promotes a set it and forget it mentality, and it makes it easier for, again, these firms to sell financial products, and they're less engaged with you, the investor. Think about when you drive your car. If you drove your car like asset allocation, set it and forget it, what would happen? You'd probably get in a lot more accidents. When you're behind the wheel of the car and you're driving down 75, you have to be alert, you have to look forward, you have to look side to side, and you need to look back. And if something's coming in front of you, you're going to adjust. You're not going to put cruise control on and plow into the car in front of you. But asset allocation is kind of like putting your portfolio on cruise control. You're going to own assets that are always in the portfolio that maybe don't belong. You're not going to look at dynamic changes in the economy or pro-growth policies. What is that going to do to the risk? It's going to increase the risk of your portfolio. What's it going to do to returns? It's going to potentially bring down the returns of your portfolio. Owning certain assets all the time, and probably the best example I can give every investor, is if you own bonds or long-term bonds in a rising interest rate cycle in an asset allocation set it and forget it formula, bonds drop a lot when rates go up. And you probably experienced that yourself and had lousy returns in the last 2 or 3 years when the Fed started raising rates. Again, there's times to own bonds, there's times not to own bonds or different style of bonds. Asset allocation, generally speaking, does not look at those changing circumstances and adjust the portfolio correctly. So again, we're not a fan of asset allocation, and we're certainly not a fan of set it and forget it. Sam from Naples, Florida. My financial advisor has recommended investing in mutual funds that track the S&P 500. How does this differ from buying individual stocks, and what are the potential advantages or disadvantages? Well, if you're buying individual stocks, you have to do a lot of research every single day. If you buy a mutual fund or an index that tracks the S&P, you basically have to research, hey, should I own large cap S&P? Is that an area of growth for earnings and revenue? And should I put that in my portfolio? If you're buying stocks of the S&P, it requires a lot more work, a lot more research, and a lot more expense. We manage individual stocks at Resney Wealth Management. We also utilize various ETFs and or bond type investments. All require a lot of research, but when you start adding stocks into the mix, it requires a lot more research than buying a base index. So make sure before you do it, you understand the benefits, which could be potentially higher returns on individual stocks, but it also requires a lot more work on your part. Michael from Fort Myers, Florida. I've heard about structured products as an investment option. Can you explain what they are and how they compare to traditional stocks or mutual funds in terms of risk and potential returns? First off, a structured product is a very complex investment. They're manufactured by Wall Street style firms, and they're more beneficial for the Wall Street firm and the advisor than for your portfolio. We do not like structured products, and we would never use a structured product in a management of a managed account at Resney Wealth Management. And why is that? The expenses are high. They have lockup periods, meaning your money's not fully liquid. They only track and get a % of the index they track. So again, while they may have some less risk in other attributes, they might have more risk, but they certainly have your money locked up. That is a problem with every investment. They also have higher internal cost structure. Again, another negative for structured products. But why do advisors sell these through Wall Street style firms? Because they pay lavish commissions. And since structured products constantly renew over various time frames, that advisor is constantly selling you another commission product, generating more money for him than for you. Stay away from structured products. And a warning sign that your advisor is not a money manager is if they try to sell you a structured product. Dean from Cape Coral, Florida. I'm considering diversifying my portfolio with both growth and value stocks. What are the differences between these two types of stocks, and how might they perform in different market conditions? That is an excellent question. So think about it this way. Growth stocks are stocks that are growing earnings faster than the average stock in its index, let's say the S&P. Value stocks are stocks that were growing earnings at one point and have stumbled a little bit, and their earnings are now off, and the company is trying to find its way to get back on track. So growth stocks are companies that are currently making money, projected to make more earnings than the average in their industry or index. Value stocks have fallen on hard times, hopefully temporarily. I prefer today, in today's environment, by the way, growth stocks. I think growth stocks will outperform value. There are sometimes value stocks are opportunities. It requires, again, a lot of research on your part. And as an investor, make sure you do the research. Just because a stock's down doesn't mean it's ever going to come back. There used to be a company called Sears. We all remember that big retailer. It went down, and it kept going down and out of business. Just because a stock goes down doesn't mean it's coming back. And just because a stock went up a lot doesn't mean it's going to keep going up a lot. Earnings matter, and research matters when you're buying individual stocks. Go to ResniWealth.com. Make sure you sign up for instant email alerts for free, and also check out our special reports tab. And as always, if you're unhappy with a set it and forget it portfolio, or you're just plain getting just bad advice from your financial advisor, call Resni Wealth Management. Real advice, real money management, always a fee-only fiduciary money manager, and always actively managing our client portfolios for upside potential and risk reduction. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to ResniWealth.com and download your free copy. I hope you're enjoying today's program. And as always, send your questions to Brian Resni at ResniWealth.com. We love hearing from you, and I want to talk about the current impact as we go into a new year. How should you position your portfolio? Well, let's think about the impact of pro-growth policies on investment opportunities. We obviously have a new administration coming in. The incoming Trump administration is pro-growth policies. These present significant opportunities if you actually adjust your portfolio now. One of the comments I want to make, well over 4 months ago, we started repositioning our client portfolios for a potential Trump win. We saw the pendulum go too far to the left, and we realized, doing a lot of internal polling, that people were not happy with the current government situation. And there was a big push to elect President Trump on a re-election bid. He won. I'm glad we repositioned well before he actually won, because a lot of the investments that we own seem to be benefiting from him now coming into office in January. But with the new administration, taxes are going to be coming down, not only potentially for individuals, but also for corporations. Tax cuts put more money in your pocket, more money in a corporation's pocket to spend wisely versus being wasted by the U.S. government. That's pro-growth. Regulation, lower regulation and burden is anticipated. I think there's going to be a lot of regulation cuts across the board in our government. What is that going to do to corporations' opportunity? It's going to skyrocket their opportunity. Less regulation, more money in a company's pocket means more money to spend on growing their company, giving you great opportunity. But what companies are ultimately going to benefit from this pro-growth policies? Are you positioned? Is your portfolio already adjusted? Has your advisor already adjusted your portfolio for these pro-growth policies? If you still own the same investments, the same emerging markets, the same international, the same bonds, maybe the same investments in general in the U.S. that you owned the last 5 or 6 years that kind of did mediocre, and you haven't made changes, your advisor is probably not attuned with pro-growth policies. You, the investor, need to look at your portfolio today. And you have to make sure that your portfolio is aligned for the future, not the past. We've got monetary policy easing that would also occur within the U.S. These are going to be huge beneficiaries for, again, pro-growth policies. You as an investor need to look at the future, and you, the investor, need to make adjustments in your own personal portfolio. And if you're unable to do that, then make sure you find yourself a money management firm, not an advisor, who actively manages portfolios and makes these important adjustments for pro-growth as we go forward. Grace in Gainesville, Florida. How much cash should I keep on hand versus investing it? Grace, great question. So this is what I would suggest to every investor, regardless if you're retired or you're still working. Don't leave a lot of money in cash. Keep your money always invested. If it's money you do not need for the next 3 to 5 years or longer, invest that money. So let's say the average person might leave 10, 15, 20,000 at hand for an emergency reserve. That's it. If you have a major expense coming up, let's say, hey, I'm buying a new house in a year, I need $50,000 for a down payment, keep that in cash, keep it safe. But if it's really money you don't need, keeping much more than 10, 15, 20,000 in cash at home makes 0 sense at all for most investors. Think about an investor who's got $1 million portfolio, always keeps 100 grand of cash for an emergency. Your $1 million portfolio is always liquid. So why keep all that money in cash making maybe 2%? Keep 80,000, put that in the portfolio, keep 20,000 in cash. Take a look at that 80,000. If it only makes 5 or 6 or 7% the next 10 years versus making 2, the difference in your portfolio size. The more cash you leave, the less the return on the overall portfolio and the more drag and less opportunity you ultimately have. Mike in Naples, Florida. What are your thoughts about Philip Morris stock? Not a fan about Philip Morris stock, and there's a lot of reasons for that. And it has nothing to do with that it's a tobacco company, but it's really about in our opinion, the future growth of Philip Morris. So if I look at Philip Morris and you said, there's 20 stocks in the world to buy, what would you think about Philip Morris? If there's 19 better stocks, I would be looking at other stocks. Let me give you an example. We've got a change in administration, as I talked earlier. We've got AI revolution hitting us. Things that drive artificial intelligence are going to be great opportunities, in our opinion, for could be decades to come. Things like information technology stocks, software stocks, stocks that are involved in semiconductors, areas that are going to grow. Data harvesting, basically plans that do storage, the cloud, things that ultimately are going to contribute to AI revolution, which is only going to expand exponentially over the next decade, are going to be probably the biggest recipients of growth. Sales growth contributes to earnings growth. Philip Morris isn't going to sell twice as many cigarettes in 10 years from now as they do today. But will there be a lot more cloud computing in 10 years? Probably 2 or 3 or 4 times than there is today. Certain opportunities exist. Will there be more semiconductors in the next 10 years? By multiple times than there are today, there sure will be. So again, why would I want to own a tobacco company with slow growth or no growth when I can own other areas of the economy that potentially can explode the next decade and reward my portfolio for the same amount of risk? Grant from Naples, Florida. I'm retiring in February. I have $1.4 million in a 401k plan and want professional help. Are you taking clients? Grant, yes, we are taking new clients. We do take a limited of new clients every single year. Our first course is always our existing clients, but we do have time to take new clients. Our client minimum is currently $1 million, and we would love to help you professionally manage your 401k plan. Grant, your question comes often to our office, whether it's a phone call or email. Most investors don't want to manage their own money because they don't have the time, discipline, maybe the talent, and they want a firm that actually works for them in their legal best interest. So I'm glad you reached out to us. Remember, the only kind of firm that an investor should ever entrust with their money is a fee-only fiduciary money manager. And let me explain what that means in simple terms. Fee-only means the only way that firm is compensated is by the fee you pay them to professionally manage your money. Fiduciary means they are fiduciary all the time, meaning we legally work in our client's best interest. Not some of the time, not part of the time, but all the time. And as a money manager, we actually manage the client's money. Once we go through the initial process and talk to you about your goals and objectives and risk, we then build that portfolio from hardcore research. When positions in that portfolio need to be changed, we make those automatically and then convey that back to the client. So real money management is a firm actually managing your money, doing that hardcore research that needs to be done every single day, and making those timely adjustments for your benefit. So we'd be more than happy not only to deal with you, but any of our radio or TV show listeners. If you're unhappy with the way your money's being managed, and you're realizing you currently have an advisor who's got a set it and forget it mentality, asset allocation, and it's not benefiting your hard-earned money, give my firm a call during the week. We'd love to talk with you and discuss your situation. And as always, go to resniwealth.com, click on that special reports tab. Real Advisor, Fake Advisor is one of our #1 downloaded reports. It talks about what a real advisor money manager is versus a fake one and the conflicts you need to avoid. Terry in Cape Coral, Florida. What are your thoughts on Tesla, TSLA? First off, Terry, fair disclosure, we own Tesla in our managed accounts at Resni Wealth Management. Tesla, the reason we own it is simple. It's not a car company, it's a technology company. Let me explain. While at our firm, I would never want to buy a car company like a Ford or GM just because they're really low margin businesses. They have huge debt structure. They're profitable sometimes, not profitable a lot, and they basically incur more debt. Tesla's a technology company. Yes, they make cars, but they're making many other things in the works. Robots, and I can go on and on and on. So part of Tesla is going to be a technology-driven company that's going to bet from the AI revolution and ultimately is going to benefit, in our opinion, their share price. I think Tesla in the next decade could be a company that goes up 2 to 4 times in value realistically if half of their goals are met, what they're talking about currently. This is a huge plus for Tesla and people that ultimately own that stock. But like any stock, make sure you do your research because it's vitally important that you do daily research on any stock, know when to buy, and ultimately know when to sell. Folks, let's lift the heavy weight off your shoulders. Financial stress is never good. It's time you looked out for your retirement security. Smart investors like you are realizing and they're calling Resni Wealth Management because they want real money management and they're tired of that set it and forget it mentality. Let us help you build your portfolio and build your financial security. Honesty, integrity, compassion, and competence is the difference my firm provides. Call us today. Let's schedule a consultation. I know change sometimes is difficult, but you'll be glad you called the office. Schedule that consultation and move ahead in a positive way for not only your retirement, but for your financial well-being. Have a safe and profitable day. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're a retiree, pre-retiree, have at least $500,000, this is a must-read report. I've covered the risks to your financial security and the facts you need to know to protect your hard-earned retirement savings. If you're at all questioning the advice you're receiving or your portfolio is lacking returns, go to resniwealth.com and download your free copy. My #1 tip, make sure you avoid free steak dinner seminars. They're going to give you heartburn, and realistically, all that advisor is going to do is try to sell you an annuity. Avoid annuities if you care about your retirement and your financial security.